Elon Musk was blunt with nervous shareholders during a rather highly charged earnings call. The Tesla CEO cut off analysts who got defensive about the electric car maker's finances.
Let me make a federal case out of it. You're
capital
next.
requirement.
Next. Boring bonehead questions are not cool. Next. Sorry. These questions are so dry. They're killing me. I am not here to convince you to buy our stock. Do not buy it if volatility is scary. There you go.
All right, joining us for more on the phone is Toni Sacconaghi. He's the senior research analyst at Bernstein. He has a market perform rating and a 265 price target on Tesla. Was on that call and actually got a bit of an earful from Elon Musk. So, Tony, was this unlike any other call you've experienced in terms of a fractious CEO?
This was unusual, certainly. Often CEOs can be disappointed or disturbed by questions or don't appreciate multi-part questions. But I think the level of sort of outright dismissiveness was unusual.
Will this, in fact, affect and undermine investor confidence in Tesla's outlook then?
Look, I do think certainly the investor feedback that I've gotten today is there is incremental concern when on an analyst financial quarterly call, the CEO doesn't appear to want to talk about important financial metrics. And, the read-through is that potentially the CEO doesn't care or isn't focused about those financial metrics, or ultimately the numbers don't tell a good story. But either of those interpretations are not particularly comforting.
Yeah, I mean, one of the things that's so striking about this, Tony, it seems to me, is that this is a company and a management team that really needs support from investors and the street, not to antagonize, but to reassure. You think of all those years that Jeff Bezos persuaded you all to keep money in despite no profit. Do you think there's an end game here or just a man who lost his temper?
Look, Elon is a brilliant visionary, and he has extraordinary strengths. But, clearly at times he can become frustrated with the mundane, and he can be temperamental. And I think that's what we saw today, last night, excuse me. And so I think for investors who know Elon, they're probably not entirely surprised. But as I mentioned before, a reticence to discuss financial metrics in a forum that's created for financial metrics can be incrementally worrisome.
Okay, so let's discuss some of those metrics, revenues, margins, cash flow. How did they do compared to your expectations?
Well, the quarter itself was really in line. I think for me, where the incremental disappointment was the company has been stating that it believed it could get its Model 3 margins, gross margins, to 25% once it got to a volume of 5,000 cars per week or shortly thereafter. So the implication was that might happen in the third or fourth quarter of this year. Last night on the call, they said no, they didn't think gross margins will get to 25% till mid-2019, and that they would likely only get to 20% by the end of the year. So the gross margin trajectory is weaker than the company thought 3 months ago. And that's important because gross margins obviously are an important driver of whether a company can make money. And making money has been elusive for Tesla. So that being pushed out 6 or 9 months was certainly an incremental negative in our eyes.
So cash flow, very important. They're reiterating that they can become cash flow positive for the third and fourth quarter. Is that possible?
It takes a pretty Herculean set of assumptions. By our calculations, they'd, really have to scale back on growth and research and development and selling and marketing SG&A expenses. So we think that, in order for Tesla be profitable and be cash flow positive, those expenses might only grow 15%, whereas revenue might grow 70%. That's a pretty big disconnect. And so we do think that getting to cash flow positive, while not impossible, will be difficult to do. And in doing so, it may have unintended consequences in terms of starving spending in other areas.
Tony, there are those who are saying this is not a week for you. You got yelled at on one conference call and put a bearish note out on Apple just before it surprised the market. Why did you get Apple wrong to that extent? How did Apple manage to surprise that way?
Look, we did get Apple wrong going into the quarter, and there were a lot of supply chain data points that were very negative. And I think our interpretation, as well as some investors, I think investors were surprised as well, which is why the stock was up considerably yesterday. Our interpretation of those data points was that the iPhone cycle would be weaker than what Apple printed. And that turned out not to be the case. They appear to be enjoying a somewhat normal seasonal quarter, a seasonal cycle for iPhones, and that was clearly a surprise to us, and I think more broadly to the marketplace.
Does this change your long-term view on Apple at all?
No, we've had a view on Apple for a couple of years that the stock is not a core long-term holding. And what we mean by that is we worry that the iPhone is such a big part of Apple, and that over time, the iPhone itself is a relatively mature business. We don't think it has much growth, and we think over time, replacement cycles for iPhones will probably extend. And so, we really struggle to see whether there's going to be iPhone growth going forward. So if your principal business, which is 65% of profits, and then it helps drive part of services, which is another 20% of profits, if you don't have a clear path for growth, we find that hard to say this should be a core holding in your portfolio. Now, that said, the stock has made people a lot of money over the last couple of years by buying at the right time and selling at the right time. And so I do think it is more of a trading stock. And coming out of earnings, my guess is the next move in the stock is probably up. Does it mean I want to buy it and own it for the next 3 or 4 years? That's less clear in my mind.